We hope everyone is safe and healthy. We had originally scheduled this as a panel for our New York Spring event, and which was graciously hosted by Amico, Komoda, and Goldman Sachs. So wanted to give them a little bit of a shout out for their continued support of the fixed trading community here. I also wanted to thank our online sponsor, which is XTRD, for supporting this webinar. And I'd like to give Sergey Gulko, the CEO of XTRD, a minute to speak to the virtual audience here. So, Sergey, you have the floor.
Thank you very much, Lee. So, hello everyone. My name is Sergey Gulko. I am co-founder and CTO of XTRD. My journey with the FIX started about 12 years ago. As an engineer by first education, I clearly see the importance of standards. They exist not to limit someone's wild creativity, but to make cooperation easier and give you freedom to focus on more important things. And this works for maths, physics, mechanics, and other disciplines. And history of FIX shows that it works for finance as well. And in a highly dynamic world, standards become a setting stone for the future growth. And digital assets right now, it's in the age, and we and XTRD see the mission of unifying worlds of traditional digital finance. As a member of the FIX trading community, we actively promote FIX among companies involved in cryptocurrency trading on both buy and sell sides. And sponsoring of this webinar is just a small sign of appreciation for protocol and people behind it. So Lee, floor is yours.
Great. Thank you, Sergey. As I think we can all agree to, FIX is going to play a prominent role in the next generation of financial services, especially in the digital assets. And obviously we'll touch upon that a little bit earlier today. So thank you again. So before we get started, there's a few housekeeping rules. If you have any questions, please raise your virtual hand, and we'll be alerted to your question. This time around, we're also doing some polling questions, and we'll start the panel right before we kick it off with a polling question in a minute or two. Also, this webinar is being recorded. However, we're still under Chatham House rules, so please do not publicly quote any panelists without having their express consent. Lastly, if anyone in the virtual audience is a bit shy or doesn't want to raise their hand, feel free to, or wants some more information about FIX membership or how you can sponsor a future virtual event, please feel free to email me or the program office directly. So, that said, let's get into this a little bit. So this panel, as you're all aware, is titled, Are You Ready for Digital Assets? An Institutional Perspective. The panel was really designed to give our membership insight into how the plumbing of Wall Street is being overhauled using the next generation technologies, and to really, not give let our members be caught empty-handed when this changing of the guard occurs. So today we're joined by some very accomplished folks in a diverse panel of experts who are all working on this next generation of infrastructure. However, it's from slightly different perspectives. So we designed it, again, to give this broad range of insights around from digital asset exchanges to broker-dealers like RSX, Goldman Sachs, and even my own firm, Rialto, to premier service providers like Line Data and XTRD. So with that said, I'd love to get just hand it over to each panelist for a brief background about themselves and what they're responsible for at their respective firms. And maybe, Tom, we kick it off with you.
Thanks, Lee. And mild correction there, Eris is actually CFTC regulated futures exchange and CFTC regulated clearinghouse, not a broker dealer. So we're very traditional and normal, even though we're in crypto. But I'm Tom Chippis. I'm the CEO. I'm simultaneously responsible for everything and nothing. My history is more in the capital market space. Obviously been associated with FIX for a very long time, and can remember the quaint days of trying to figure out how to connect algorithms via FIX to broker-dealer execution desks, and seeing the evolution of it from there to now. Very excited now to be part of the crypto community and operating a spot market, so spot commodity market for cryptocurrencies, and futures market and clearinghouse at RSX. I and our team have tried to bring a lot of what we know works from traditional capital markets to the crypto landscape. And the deeper you go into that rabbit hole, you'll find that so much of the crypto infrastructure, so much of the crypto workflows really came bubbling up from people that do not have capital markets backgrounds. And they've taken some very different approaches. And we've tried to be open-minded and informed by that rather than just pointing at it and saying you're doing it wrong. So hopefully on this panel here, we can share some insights of what those of us with a few miles under our belt have learned and what those new to the party are bringing.
Great. Garrett, you want to take a shot?
Yeah, sure, absolutely. Greetings, everyone. I am Garrett Nenner. I am Global Head of Trading Product for Line Data, OMS, and Asset Management Tools. My role involves creating the next generation trading capability for our global client base. I'm a former quant fund PM and head trader and financial market structure specialist. I've been involved in building advanced buy and sell side trading and algo desk for our markets for half my career. I've been involved in the digital assets and blockchain space since 2012. During this time period, among other institutional products, I built 2 professional trader cryptocurrency trading applications and more recently built an institutional level digital asset trading application and dark pool with appropriate blockchain to fixed translation and all that entails. Needless to say, I'm very much looking forward to today's conversation. Thank you.
Great. Justin, I hear you. I see you out there.
Yeah, I'm here. Sorry, my video doesn't seem to be working for some reason today, but can you hear me on audio?
We can hear you loud and clear.
Okay, great. Yeah, my name is Justin Schmidt. I work for Goldman Sachs. I am our head of digital asset markets, and what that means is I oversee our very, very nascent Bitcoin non-deliverable forward trading desk. What that means is that we trade a product that looks somewhat like the CME future, but is traded bilaterally. We do not, at least not yet, touch any of the spot crypto itself, but very much interested in seeing how the market progresses, learning what people are doing, seeing what best practices are. With that, I'll turn it back to you, Lee.
Great. Thank you, Justin. And Sergey?
Yeah, so hello everyone again. I will try to be as brief as
Uh-oh, did we lose him? We had it frozen a little bit. I'll take a stab at this. So I'm Lee Saba. I'm your moderator for today. I'm one of the Global Steering Committee co-chairs for the fixed trading community. And I'm also the head of market structure for Rialto Markets. We're a broker-dealer focused on regulated blockchain-based digital securities. And we also focus on secondary trading using our proprietary ATS. So with that, I think we already met Sergey. You froze a little bit there, Sergey. So
It's better right now?
It's better now. You want to give it a shot?
Yeah, sure. I will try once again and try to make it shorter. My name is Sergey Golko. I'm co-founder and CTO of XTRD. Our company run a platform that utilizes fixed protocol to stream market data and allow and facilitate trade across multiple digital asset exchanges. So we literally are OMS system, which acts as a translator between all those WebSockets, REST APIs, and from one end, and the fixed API on the other end. And prior to starting XTRD, I spent a decade as a CEO of Action Software, company specialized of building high-frequency and ultra-high-frequency solutions for FX markets.
Great. Thank you for that. So, Deb, could we queue up the first poll question?
Sure. There you go, Lee.
All right. So I don't know if there's some folks on the phone, but the question is, what is the largest computing power on the planet? And there's 6 or 7 options here. If you would like to vote, please click your button now, and you'll be able to go. Actually, it says hosts and panelists cannot vote, Deb.
Yeah, sorry, guys.
I have inside information. It's an insider vote. You know the answer.
Will that be corrected, Deb, or?
I'll get it corrected for the next question, hopefully.
Okay. Well, the answer is the Bitcoin blockchain, and it's approximately 10 times larger computing power than all of the top 10 supercomputers in the world. So looks like we had a pretty good response here. 45% got it right. So looks like our folks are pretty well informed here on the in the audience. So thank you for that. All right, now we're going to get into it here. So first question. I recently attended a presentation by Matt Walsh of Cast Island Ventures, where he presented his views on categories of digital assets. And his three major categories were, one, the money tribe, which we would describe as, something like Bitcoin and Libra and that. The tech tribe would be number two, which would be, Ethereum, Filecoin, in that genre. And then the tokenization tribe, possibly the JP Morgan coin, what Wisdom Tree's up to, and even my own firm, Rialto. So do you agree with this assessment of these three tribes in the digital asset framework? And if so, why or why not? And I guess I'll start with Justin on that one.
Yeah, sure. Thanks, Lee. Yeah, I think it's a good question, and I think that the categorization of digital assets is a very challenging problem. I think anytime you try to break it down in sort of one dimension and into one set of pieces, you sort of end up with a little bit of difficulty because it is sort of this higher dimensional space. In terms of like asset categorization or asset classes, I think you can break things down. Like the money tribe seems to make sense to me. Things that act as monetary instruments, and then things that aren't monetary instruments tend to be more financial instruments. And then those financial instruments you can break down into things that are securities and things that are not securities. And this is sort of a legal categorization, and I think that you can look at it from that lens. You can also look at it from more of an accounting or financial lens. You can also look at it from a technological lens. And I think one of the interesting things about the digital assets is that you can tokenize these things, and these tokens represent fractional ownership in something, and the tech is almost completely agnostic to what the underlying asset underneath it is. And I think there are other interesting dimensions you could break down here. You could look at whether the underlying ownership is anonymous or if at a base layer it's KYC'd. And then in the tokenization tribe, I think I would sort of more categorize JPM coin as a money tribe coin, I guess, according to his categorization. And then the tokenization, Rialto, other security token platforms, digital securities, whatever you want to call it. I think that's sort of a different type of animal as well, because you end up with different regulatory regimes. So digital asset is this very broad category. I think it encompasses various different types of assets, and each of which have their own jurisdictional requirements, and also each of which have their own per asset class type regulatory environment as well.
Yeah, so it sounds like you think that you generally agree with the three tribes that he mentions, but it sounds like there's even more granular within each one of these tribes. So you can get more into maybe it's a neighborhood or something within the tokenization tribe that you belong to. Okay, it does. As far as follow-up questions, where do we stand on the regulatory front? And Tom, I know you've had a recent win this week, and congratulations. ErisX received the NYDFS bit license this week. But how do you see the digital asset landscape, and probably more primarily towards the ErisX world, being regulated, and where do you see there's work to be done, and then what have we accomplished so far?
Thank you, Lee. We're really excited to have been issued the virtual currency license, the bit license, by the New York State Department of Finance. Just another feather in our cap with respect to building an appropriately regulated market that's safe, secure, and transparent for participants. So, ErisX lists two different types of digital assets, all related to cryptos. So, on our spot market, which is really a spot commodities market, we list things like Bitcoin, Bitcoin Cash, Litecoin, and Ether. These are all accepted as commodities, known to be commodities. They're digital commodities, and we've built a market that looks and operates very much like a physical commodities market. So on the spot side, we're regulated at the state level. We have money transmitter, money service bureau licenses. We are FinCEN registered. And of course, we have now the BIT license in the state of New York. So this allows us to open accounts for individuals and entities, hold cash, hold collateral, process trades, and move that money about. So at this point, we're licensed in 47 states, with the remaining states and territories coming quickly. And that's really the spot side, where it's inconvenient, in the opinion of many in our space, to have to make so many applications, deal with the ongoing audits and all those other sorts of things. At RSX, at least, we've taken the approach that if you want to operate in the United States, these are the rules, and you can certainly attempt to change them. You can certainly rage against them and attempt to have replacement rules written that override them, or you can just get on with the work. We've chosen the get on with the work approach, and it's worked out very well for us now that we have all these licenses. Of course, it's very different in other places in the world. There's sort of the lightly or unregulated world, or sometimes there's less professional and polite terms utilized to describe some of the other crypto markets that exist today that are regulated or lightly regulated in other jurisdictions, but they're not able to operate in the US or take US customers. That's certainly not our focus. On the derivative side, we are a CFTC licensed exchange. We have a DCM, derivatives designated contract market license, sorry. And then we are a CFTC licensed clearinghouse. We are a derivatives clearing organization. There's very few DCOs. So we're very proud to have that license. And these two licenses allow us to list derivatives on cryptos and allow us to clear those as well too. And as a clearinghouse, we of course hold collateral, hold cash, can open accounts for individuals and for institutions. So we operate under both those frameworks. They're of course related. The CFTC does not regulate the spot commodities market. They can get involved in cases of fraud or manipulation or what have you, but then they do regulate our products on the derivative side. And the derivatives we offer are physically delivered crypto, currently in Bitcoin, with others coming soon. So we have a very clear framework. We deal with commodities. Those commodities are regulated under the various formats and regulators that I've described. We're not currently involved in what I would call, in that last of the three tribes, the digital or digitized tokens. Really, from my perspective, when we get into all the questions of tokenized assets, if we strip away the word token and we strip away the word digital, I find it very helpful to look at what it is. Is it a share of common equity? Is it a preferred stock? Is it an ADR or GDR or some equivalent sort of alternative listing? Is it a convertible note? Is it some form of debt? And I think when you strip away the word digital and strip away the word token, it actually becomes a bit easier to understand what it is you're trying to trade, and then which frameworks you need to apply. In my opinion, over the last few years, there's been way too much focus on, well, it's digitized or it's a token.
Mm-hmm.
But in the US, equities essentially are digitized. They just happen to be stored on a central record in one place, essentially all owned by one entity. And that doesn't mean that because they're digitized, they have all the features and functions that people want from a tokenized digital asset. But I think if we start to break that conversation down and look at what it is first, and then how do we apply these feature enhancements, these service enhancements on top of it with the digital and tokenized frameworks, it might be a bit easier. That doesn't seem to be the approach today. And we're waiting for more clarity in those spaces before we dive in. So we're staying on spot commodities and regulated derivatives, very watchful and interested in the evolution on the digitized and tokenized asset side.
Yeah, I really like that approach and the way that you framed it, as far as, removing the token or digital aspect, out of the concept and just, treating it for what it is. We have a saying at Rialto, it's not because it's blockchain based that's making it attractive. It's a good investment first and foremost. And then, the blockchain based functionality enhances the experience. So, it starts with a quality asset at first. And if I'm reading the tea leaves correctly, you and RSX are planning on institutional workflows based upon all of the licensing you're getting in the style of infrastructure you're building out. So that's great to hear. Any other comments from our other panelists on that?
Well, I think it's not really fair to strip word token or digital security from what we're doing, because it's not just a concept isolated from the technology, because it's really a technology plus regulation. You cannot apply certain rules without dealing with the technology itself, with all possible technological risks and limitations. But again, it's my personal opinion.
That may be, but we've gone through big technological shifts. I mean, everyone in the fixed community has seen it as well too, right? Think about the asset class expansion and the functional expansion, right? And how long it took to get things like allocations and other things done via fix. These are all workflows that are enhanced by the technology, and certainly I would agree, new risks come up, and that has to be part of anyone's risk assessment. My comment was more at a personal level. I look at a lot of the debate around, well, it's a token and it's not a security yet, but it might be later. If you step back and strip away the digital and the token and say this were a piece of paper and I were buying a convertible note of some kind, okay, I'm holding debt, and at some point in the future, the company distributes equity to me because I've converted this. It becomes a little bit easier to tease out what's a technical risk that you need to look at versus the analysis of what are the ownership, the cash flows, the rights that go with this particular instrument. And that is really what my reference was. But I agree with you, Sergey. There's new technical risks that abound when you get into the application of these new technologies. I don't know that they impact the analysis of, is this a security or not? And I'm not a lawyer, so this is not legal advice. But I just think it would be, from a common man perspective, easier if we started to tease these things apart a little bit rather than mashing them all together and trying to unwind the ball of string as the solution.
Yes, yeah, so actually, I'd like to comment on that. And to start, in full disclosure, please note that all opinions made here are mine. We have to say that, right? And not those of line data, but I do have a lot of opinions. First, Tom, exactly with what you said is, when you do take the terminology out, yes, it does make it more digestible. And also to what you say, leaning towards that, is there's always a new instrument. Just look at swaps. They're complex, right? And it's not just one security and trading them or unwinding them, et cetera. That's a whole nother process. So this is just another process. Hey, we use software and you have the cash, you can do almost anything, right? So I fully agree with your point. And to Sergey, yes, we can't ignore the facts that it is a new security type, but soon to be, et cetera. But it is a little bit outside the realm of current technologies, and that's why groups like ours are the ones that are looking deeply into it and find a way to bring it into the norm. So.
Yeah, great. So let's pivot a little bit to stablecoins. I know we had a little bit of chatter on this in earlier discussions. Sergey, I know that you were pretty vocal about this. Would you mind talking a little bit about stablecoins and how they play in this world and why we use them, and then talk about how they're going to theoretically improve the ecosystem?
Sure, definitely. But to answer this question, I need to rewind a little bit to the beginning of this conversation. Speaking of tokenization tribe, my personal opinion, again, it could become a future of digital assets. And so you can, or potentially will be able to tokenize different types of securities and even fiat currencies. And TLTs give you a possibility to create truly incredible mechanism of wealth management and distribution. It's like you mentioned your token. You also can do it. But in order to achieve all these benefits, we should have some kind of reflection of real fiat currencies on a chain. It could be dollars, euros, yens, or rubles. Don't really matter. But governments don't really want to do it, or maybe they do it in the future. But demand is clearly here. And that's why we have all those stable coins. In simplified case, it works as a digital representation for, let's say, dollars or euro on a chain. I personally see stable coins as a fuel for digital assets trading. I understand that for equity and FX market professionals, with all the centralized clearing and net settlements might sound a little bit strange, but in digital assets, having ability to quickly move big chunk of money from one liquidity pool to another, it's a very valuable instrument.
Now, that's if I may interject, we talk a little bit about coins, et cetera, stable coins, yes. If we look at the US dollar coin, or even Sweden with the e-krona, what is that? Actually, this February, they began to do their research actually in 2017, but this February they actually started, playing with it a lot more and testing. The Central Bank of Sweden just began doing this, recently. They're a step closer to getting this off the ground. It'll probably will be only between banks, I imagine, not into the civilian use. But also, I think if we talk about the dollar coin, just so that the audience, I don't know how much the audience knows about the dollar coin, but if you don't mind, I'll just go through a few points just to explain it.
Please.
Okay. All right. So the dollar coin is issued by the Center Consortium, which is right now it's Circle and Coinbase. They're looking for others to join. Circle is a company that owns Poloniex, which is an exchange, which is also backed by Goldman here. The dollar coin appears to be more trustworthy alternative to Tether, which is really an unregulated and really not strongly controlled. The dollar coin would be U.S. based and is fully U.S. dollar funded, and all this is verifiable through public record and internal audits. Why is it trustworthy? Well, the U.S. dollar coin is still centralized. The dollar reserves are in the hands of the consortium, and the dollars are redeemed through them. The coin was issued on the Ethereum blockchain as an ERC20 compatible token. And in order to make sure that coin remains fully dollar backed, they will issue and burn tokens whenever there's a deposit or redemption. The dollar peg would be maintained through a combination of supply, demand, and no arbitrage pricing dynamics. And the primary listing for this token right now, it's on Coinbase, but you can buy and trade them on 5 different crypto exchanges. I think it's Binance, Poloniex, LA Token, IDCM, but I'm not advertising for them. I'm just for information. And there's strong turnover for the token on all these exchanges currently, and mostly bigger block orders. So it is being, shall I say, played with, utilized, et cetera. And so in figuring when this is going to come out, we don't know, but just to understand that when we're looking at more stable coins, there's going to be a lot of regulation around it. We got to protect protect the public, protect the industry, and so forth. But I think it's an interesting time that this is even started. So it's worth a little bit of research to learn more about it, because this is one of the first steps into it. Thank you.
Yeah, I think that was a good synopsis of what stable coins are about and what they're capable of. And I've been thinking a lot about something else that's a federally reserve, the Federal Reserve issued dollar, blockchain based token, which it's not like a dollar. It's not a stable coin per se. It's actually issued by the Federal Reserve Bank, and it is a dollar represented in a tokenized form, which I wonder what that will do to the state of stable coins, because if you receive one of these, a U.S. dollar administered by the Fed, it feels to me like it puts a lot of pressure on the stable coin world. And Chris Giancarlo, the ex-CFTC chairman, is a strong proponent of this. And there's also been a strong push in China to issue their own, I guess, fiat version of a digital asset, and they're starting to force some of their people to start taking it and open up wallets. So I'm curious what the panel's position is on, should the U.S. implement a U.S. dollar coin, and again, not a stable coin, a true dollar represented digitally.
Lee,
We also, oh,
sorry,
go ahead, Tom. No, go ahead, Tom.
Thank
I'll
you.
wait till you finish. Yeah.
I think when we're going down this path, it's really important to ask a question of what is it we want out of this new widget. And just very quickly, Garrett, Poloniex actually was sold to Justin Sun several months ago, so it operates outside the United States now. I don't believe any of the entities you described are involved with it any further. So it's moved from the regulated space to the wild east at this point.
Oh,
So with respect to stable coins, what functionality do we want? What purpose do they serve? Really, if you split the stable coins into things like USDC, like Garrett was talking about, or TrueUSD or Gemini Dollar or Paxos Standard or some of the other ones that exist and are issued by entities in the US today, they're trying to fulfill a functional need, which is cryptocurrencies trade on a 24/7 basis. US dollars via the Fed does not move on a 24/7 basis. Ergo, you have funding and timing issues to deal with if you do want to move the US dollar value between different exchanges that you're trading on. So these coins have been created to fill that functional gap. The biggest one of all, and not by a little bit or a lot of it, the only one that matters statistically, if you actually look at the size of them, is Tether. And Tether operates outside of the US governmental regulatory reach. There were some fascinating documents that were made public through the case filed by the New York State Attorney General. And what it shows is that if you're willing to put dollars in an exchange and buy Bitcoin and send it to someone using the name Merlin on a Instagram or Telegram, channel, they'll create USDT for you. And they've created billions and billions of them. What's the use case for Tether? The use case for Tether, one, is the 24/7 fulfillment of collateral movement that I've talked about. But two, is to give access to US dollar denominated value to people that otherwise wouldn't have it. So for people that are not in the US and or can't get through KYC, AML, and all those other things, but they want to be able to hold digitally a dollar of value and move it at will 24/7, Tether's your solution. So if you are trying to solve for the first case of move dollars 24/7, a digitally issued dollar by the Fed that can move 24/7 would really seem to solve for most, if not all of that. Interim solutions exist today. People like Silvergate and Signature Bank and others allow for 24/7 movement of dollars. Their solutions are very, very helpful to the crypto industry. If you step back and look at them from a technologist perspective, it's a pretty boring solution. We all go open an account at the same bank and journal entries move 24/7 between them. It's not works. But if the Fed were to issue a digitized dollar that could move 24/7, that would seem to solve for a lot of what people that are willing to be operating in the regulated world need to solve for. I don't think it solves for the secondary use case, which is I do not want or otherwise cannot get access to the US dollar banking system, but I'd like to be able to store value and move it 24/7 denominated in dollars. So I think what former Commissioner Giancarlo is doing is a great step forward for the US to help us put a digital dollar out there to solve that first use case and then provide a foundation and a platform to address bringing other people into that. But it won't solve for the I want to stay away from the regulated, away from the disclosed world use case, which is really what Tether solves for.
Yeah, great point, Tom.
Well, having this on a blockchain, you potentially might have even more control over the dollar because you don't need to deal with the banks. You need to just simply have a proper contract and proper, I don't know, white or blacklist addresses management. So you can literally control money, in someone else's pockets.
Yeah, there's definitely a control risk there, and I'm sure there's a lot to be said before any of this gets underway. But it's nice to see that we're starting to move in that direction.
We also have to understand how disruptive it will be, too, in transferring funds that way to traditional methods. Middlemen, et cetera.
It could change how we look at atomic settlement versus net settlement, right? If it's cheaper and what have you. I actually think there'd be some downsides to getting away from net because the crypto industry sees it today, fully funded markets. atomic settlement, it's very expensive from a collateral perspective. So to bring efficiency back into the market, you might need to do some netting, but that might be happening at a micro level if we can move the dollars that quickly. There's lots of room to take the benefits of the technology and innovate for sure.
Great. Hey, Deb, with that, are there any questions from the audience?
Yes, we have a question. Todd, you have a question. Could you please, state your name and the company you're calling from?
Yes, my name is Todd Golub. I'm with Synthesis. We do some post-trade reporting, and so I know you guys are on the creation, the trading portion of it, and even some of the backbones. But as far as post-trade regulatory reporting, what are the processes? To whom do you have to do that? Tom, I know you mentioned a couple of regulatory agencies, but how does it actually flow downstream?
I just quickly answer for us with respect to the derivatives markets. We're obliged to report things like open interest and other components of activity of the CFTC, no different than any futures exchange or clearinghouse has to report. So that one's relatively straightforward. On the spot side, there aren't necessarily those sorts of daily reports that have to be generated, but for those that are transacting on our platform, we provide all the data that they would need and integrate to quite a few of the tax providers that have sprung up. And when I say tax providers, sorry, I should be clear, services that take your crypto transactional data and provide tax reporting for you. So we have partnerships with a number of those, and it's sort of a point and click thing from our portal where you can send the data out and then load it into one of those providers. So traditional on the derivative side, as you'd expect from any derivatives exchange and clearinghouse, and then we're just providing the data in a convenient format and have integrated with the tools our customers say they like to use.
Lee, there's another question here from Dave. Dave, you want to say your name and your firm, please?
Unmute now.
Yeah, you're good.
Hi, Dave Weisberger from CoinRoutes. Yeah, one of the questions I've had, it's really more for the fix, for Serge and Lee from the fix side, is that, we for those who don't know, we process market data from many exchanges and provide algorithmic trading to clients who trade across those exchanges. And one of the big differences between crypto and other asset markets is the granularity of the tick sizes, which means that, for example, and I could do it now, but if we look through our data at any point in time, we're tracking thousands upon thousands of price levels in Bitcoin. So like, for example, if I go to look to see where the depth is for 2000 Bitcoin, generally we're going to look through 1000 price levels. That's problematic with FIX because FIX doesn't have matrix oriented market data. So I'm just curious if, from a FIX market data perspective, if there's any thought about upgrading or consolidating, like vary to dollar increments or whatever, or something to enable people to see it that way.
Okay, so let me try to answer this question. Well, actually, we are streaming the same data your company are consuming, so I'm more than familiar with the problem, but I cannot say that I see any technological difficulties. Well, besides the enormous size of the order book, which you potentially can manage on your end and then simply send to your customers small incremental updates, because based on what we are seeing every day, that the activities are happening just on the first five levels, and the rest of the book remain unchanged. So you can very simply use fix protocol to stream those small incremental updates. Unlike to many other but let's say majority of the cryptocurrency exchanges prefer to send you entire book. So every time someone posts a trade, they will send you 300 levels or 400 levels, which of course not very optimal. But using fix or routing or market data streaming providers like our company and several our competitors, you can optimize this flow. So it's not about FIX itself. It's about additional layer between you and other exchanges.
Yeah, I would. That's a great question, Dave. And we certainly have the Global Technical Committee of FIX taking a look at a various amounts of data and constructs within the new ecosystem here of digital assets. That's something we should tease up and approach with them and see what the appetite is. I've been thinking about this new concept of our FIX lab. We'll throw it in there and see what comes out. But yeah, no, it's a great question, and let's be sure to follow up on that, so we can dig a little bit deeper on it.
Yeah, feel free, Lee. As I said, I think I've told you, we process around 10 terabytes of that market data a day in order to synthesize it for our clients. So it's a non-trivial problem, but I was just curious.
Yeah, well, we are facing the same problem, but initially when we started, we thought, okay, let's keep everything in raw format in a way that we received from exchanges. But then we quickly realized that we have a petabyte farm just to store some nonsense, and then we switched to the FIX format. So every data we store is stored in a FIX format, in a way of incremental updates.
Great. So maybe we move on a little bit here, we're running out of time. We got about 7 minutes left, but I really wanted to get into this one question here. Where are we? What's the state of the ecosystem right now? Right? Are vendors and service providers up to the task to take on this new this new financial plumbing? And how are your various firms approaching this? I guess start with Garrett.
Oh, ask him to unmute.
Oh, there you go. Sorry about that. As you can see from the beginning, I've been involved in the crypto markets for quite some time, and certainly I've bumped into the issue of, the first early adopters would be, let's say, the hedge fund, depending on their charter, whether they can pull in assets that are I guess, or less than regulated to some extent, and how they would be able to show that into the portfolio or manage risk, et cetera. So in dealing with that, obviously there has to be that blockchain to FIX communication, not just importantly to be able to display what you have on your screen and what you have in your portfolio, but also the ability to do the forensics on it and trace it back down to the blockchain. And then also you have to prove, was this, who do you buy this crypto from, or who do you buy this asset from? Was it a bad actor, so to speak? So there's a lot to be done in this space to ensure that those controls are there. Now, basically on the trading side, I'm working on a trading application myself. So my focus is, let's steal what we have with today, but build the stairs to the next floor where this might occur. Right, so paying attention. Obviously, like any vendor, any software team will build it when they have enough requests for it. Obviously, you have to manage your spend and understand where the future is. So, personally, I'm always keeping an eye to what the next thing is. Like I said, I was involved since 2012. I have seen the motion. I've seen companies come in and companies go. Earlier to Tom's comment, it just happens. So we have to make sure that we're on the right track. So my main point is, yes, I'm certainly paying attention to this, because as it comes to the forefront, as companies are interested in adding this new security type, we have to make sure we can provide for it.
Great. Hey, Justin, I want to get some comments from you and regarding how is Goldman approaching this, and what kind of demand are you seeing or inquiries from your clientele about accessing these new markets?
And by new markets, do you mean Bitcoin, or what do you mean?
I would say just digital assets. I mean, and again, not going back to the tribes a little bit, but the various ecosystem here. Like, is there traction building that you can see? I mean, obviously, Tom and ErisX are building out this institutional grade plumbing. FIX is clearly involved. Surge's company, Line Data. Like, we're all seeing various.
Sure. Yeah. Yeah, I mean, so I sort of separate out like a crypto like Bitcoin from the rest of the different things. So if you know we would do something like a bond issuance, and that bond issuance would be on a blockchain, for example, I actually don't think that from a client perspective, and whenever you have an issuance like this, there's two clients, right? There's the issuer itself, which is looking to raise some money, and then there's the investor, which is looking to invest in debt of a certain corporation or whatever, right? So there's sort of two clients. There's both sort of the producer and the consumer. Um, I actually don't think from their perspective, they particularly need to know that the underlying plumbing underneath the bond is a blockchain. I think that they might get some benefits because it's a blockchain. It might be safer to issue. It might be faster for them to get their money. Operationally, it might be a little bit cheaper to do. So sort of safer, faster, cheaper. But at the end of the day, you know, I come from a buy side background before Goldman, and generally speaking, I didn't worry too much about the underlying plumbing beneath what I was buying. I really cared about the quality of what I was buying, and then other exogenous risks around, say, liquidity and you know, correlations and these types of things. But generally speaking, I didn't worry too much about the plumbing. So I think that the end investor and the end issuer, frankly, kind of don't really care. But it's more of us on the banking side, on the infrastructure side, on the exchange side, where you know we see some of the pain points in the financial ecosystem because we're the ones trying to make things happen on behalf of our clients. And you know, so I think from an actual client perspective, there's definitely, I'd say, some green shoots of interest in Bitcoin more recently. It tends to be very correlated to whatever the price of Bitcoin has been doing over the past few months. You know, in earlier 2018, and you know, when Bitcoin was much hotter in terms of price action, there was a lot more interest, and then frankly, there has been I'd say a very long lull of which we are still firmly entrenched in, where the institutional interest sort of looked into what was going on, and you know, saw some of the market participants and saw that the infrastructure wasn't ready. Overall, I think the ecosystem has made a lot of progress since, say, this time in 2018, and definitely since this time in, say, 2016. But in terms of institutional demand, I think what we're seeing is still very muted.
Great. Thank you for that. We're getting a little shorter on time here. Deb, can we get? Oh, sure, Tom, shoot.
This question of when are the institutions coming is a constant refrain, and the when will traditional providers come into the market is another constant refrain. You know, ErisX just announced over the last month, Fidelity is connected to our market, TradeStation connected to our market. Our roster of investors is a creme de la creme who's who of strategic institutional players. We have vendors connected to our platform. You know, people like Dave have been you know, working in the markets and in fix for decades, and you know, for him to trivially say, yeah, it's 10 terabytes of data every day, you know, it's non-trivial. Like, that's Dave being a little bit too subtle. So I congratulate you, Dave, for just nodding off 10 terabytes, no problem. There's a lot happening here. We have people like Caspian, who came out of Toro, that have created platforms. People came out of State Street, like Hugh Lang and OmniX, creating platforms. There's a lot there. And I think the traditional capital markets market structure play of, well, we'll just wait till it's big enough and pay a premium to buy in later. It might not work out this time. It might not work out because there actually is growing institutional demand. I think when we start to see January Fed rates trade negative, as we are today, you really got to start to wonder where you want to put your money. And the use case for Bitcoin just keeps getting stronger every single day. So I've been part of the, we'll wait till the bigger, we'll buy them later approach for sure, definitely. I think it might be different this time. And of course, I'm talking a little bit of my own book here, but I think that a lot of the commentary I hear in 2020 sounds just like the commentary I heard in 2018 and 2017. But the world's changed and people are coming into this asset class. And I know who we're onboarding onto our market, and some of those have been publicly announced and some of those haven't. They're institutions, and they're gathering funds and gathering money and deploying capital on behalf of customers that are looking for whatever it might be: digital store of gold, non-correlated digital asset, a hedge against the dollar. There's different themes. The great part about a market is all those themes can come together, expressed as a price, and people can say, you're right, I'm wrong, you're wrong, I'm right, and trade against that. So I think institutions might find themselves a little bit flummoxed soon because the world's moving much faster and the old playbook might not work out this time.
Yeah, no, great point. Deb, are there any additional last questions?
Yeah, there are. How about Sam from Wellington?
Great.
Sam from Wellington?
Hi, the other panelists for taking time to talk to us. Am I on?
Shoot, Sam, you're on deck. Shoot, Sam, you're on deck.
Awesome. For any institutional investor to start looking at another asset class, like say the digital assets, specifically say Bitcoin, blockchain, the key factor to determine is whether adding this new asset class diversify the risk and provide a risk-neutral portfolio. And given the volatility that the markets are experiencing across the asset classes, does crypto assets exhibit any correlation with any of the other asset classes? We in a position to comment on that, or is it too early to talk about that correlation between digital assets versus the other asset classes?
Very quickly, I'll just say it depends what time period you look at. In some periods, it's highly correlated. In other periods, it's not well correlated. But from a volatility perspective, it's a heck of a lot less volatile than Amazon and Tesla, that's for sure.
In oil.
In oil, yes.
Thanks for that question, Sam.
You have one more question from Tom Jordan.
We'll keep going. No, just kidding, Tom. Please, floor is yours.
No, I know you guys want to get on for it, so I can talk. I was just going to ask a question of Tom and Garrett, and I'll ask them separate. So why don't we just withdraw my question, if we would?
I was teasing you.
No, that's fine. Right.
All right, thanks, Tom. So I guess lastly, final question for the panelists here. Tom, you kind of gave us a little bit of an insight into this question already, but what do the next 12 to 18 months look like, for the state of institutional adoption for digital assets? And I guess I'll just maybe start with Serge and then go to Justin, Garrett, and then Tom, if you have anything to add.
Okay. Well, so if you want someone to look foolish, ask him and make a prediction. So let's get started. So I will try to make mine based on trends we see. Well, I think that first of all, we might see expansion of brokerage services. So there are more and more companies will enter the space. And second, I think that we might see some shifts from spot market to derivative markets, because it's more interesting and for speculators. And third, it's my best topic. I repeat him year after year without any success, but I truly believe that more and more companies will start issuing digital securities. And therefore, well, again, it's inside information. I really hope that ISO will come up with a symbology standard for digital assets.
Great, thank you.
Those are my predictions.
We'll hold you to them. Just kidding. Justin, how are you feeling about that question?
Yeah, I think it's a great question. It's always hard to predict the future, that's for sure. I mean, one thing I've seen in this space is that sort of the slow and steady approach to financial innovation is the best one, and I think that you'll see more progress along the lines of various different central bank digital currencies. Whether you go live or not in 12 to 18 months, I think that's probably unlikely. I think you're going to see more and more progress in terms of just traditional finance being applied to blockchain rails. And the challenge there, I think, frankly, is there's a little bit of blockchain engineering challenge, but all the people on this call, I think you can say we've got smart people that work on our teams within our firms that can figure out the blockchain component. It's certainly a little bit new and interesting, but the engineers are pretty savvy. I think the hardest part for some of this is that, frankly, you're creating a new financial network or a new ecosystem, and in doing so, you have this, as Tom said, familiar refrain, but it's very much a chicken and an egg problem. And over the next 12 to 18 months, I would like to see various institutions come together in a collaborative way of putting together various different, maybe don't call them consortiums, but have it be based on sort of open source standards and open source, software where the actual ecosystems themselves start to coalesce and accrue into a viable platform where you actually know what platform you're going to use, and you sort of have this sort of Windows 95 moment where all the developers realize, oh, this is the platform we're going to build upon, and then you build upon it, and then you can actually have growth, and you can have a real ecosystem emerging. But I think 12 to 18 months is probably on the optimistic side for that to happen.
Great point. I like the Windows 95 analogy. Garrett, let's close us out here. Or unless Tom has something to say too. So,
Tom, go ahead, Tom.
No.
Okay. All right. So it really depends. Like, I try to look at it from, acceptance, need, and cost, right? So digital assets, tokenization, companies decide to issue tokens instead of equity securities in some way or another. I think that decision will be more on a cost basis, and also how they want to be able to control or be able to work with the current securities in a more simple way. Obviously, when there is that transfer of wealth or the transfer of a security somewhere else, what is the cost basis for that, right? Is it worth? Are you cutting out middlemen, and is that also the cost that you're saving right there? So there's that process. I know right now this, the state that we're in with I hate to say the word COVID, et cetera, but that's stymied a few companies from getting started, and I know many startups are also having issues. I think as we move forward, I think the next 18 months, we may see more digital assets being created. I believe in the tokenization movement. I do know that it will be a push and pull between the traditional and this. Regardless, I think we still have to prepare for it. We always have to stay ahead of it. The whole reason, FIX came into the fore was for a similar reason. You had to be able to manage this bring a commonality to how we were going to communicate across the industry. Yeah. So, leaving it there, it's really, I don't think it's wait and see. I think it's wait and when.
Okay, great. Tom, any last thoughts? And then I have to hand it over to Kathleen Callahan for a quick FIX update.
I'll just say two things, maybe apart from predictions that we've heard. I think there's going to be a lot of norms challenged. Two big ones I think will be challenged is one, FIX itself. If you look at the crypto exchanges that dominate in volume, they take in order flow and integrate via a variety of WebSocket and REST APIs. Mm-hmm. And many of them actually, and you're going to gag, take FIX, plug them into those APIs, and then get into their matching infrastructure. It's scary and brutal. Certainly not how RSX operates. We're FIX first, but we also have those other APIs. The other one is just access in general. More and more of what you see happening in the investor market is direct retail. Crypto certainly has been a direct to retail market from its early days. And then look who's succeeding now on the retail side, Robinhood, SoFi, Square, et cetera. I think the concept, even at an exchange level, that everything needs to be intermediated is going to be under assault. I think we're very well positioned because we work both with intermediaries and direct retail. I think people should have choice. Not everyone wants to be their own cook, chef, bottle washer, what have you. They do want to work with someone who can help them. But I think you'll see growth both in people that want more product from their intermediaries, but also want to go direct. And I think those are concepts that sound like they're in direct conflict, but they're going to do a challenge and an opportunity. So I think those two things are both going to be interesting challenges for the industry to watch over the next year.
Fantastic. Well, thank you guys so much. Garrett, Serge, Justin, Tom, this is a fantastic panel. And thank you for your time and your input here. It's super valuable to the community.
We have some upcoming webinars in the next several weeks. Improving Productivity is on May 20th, and the full FIX life cycle on June 4th. And I'd also like to mention that we have a digital asset working group. So if you'd like to join the working group and you're interested in it, please contact the FIX program office. And then finally, I'd like to thank XTRD for being a sponsor for this event, and I'd like to thank our speakers as well.